Good morning, everyone. Today is Thursday, May the 4th, and I wanted to let you know that this week is National Small Business Week. And so, how appropriate that we would have somebody speak to us about navigating the small business loan world. And so, as a guest speaker today, we do have Brian Stampley. He is a business funding specialist with a company named Yarrow Financial. Brian's been in this business for a number of years, and I would say that he's pretty much an expert in the field. So we're really happy that he's decided to join us today and give us some great information. If after this recording you would like to have a copy of Brian's deck, we are pleased to be able to send that to you in a form of a PDF file. It will also have his contact information. Additionally, after we record it, you might want to forward the recording to your business owner or to your CFO of the company, because I'm sure the information will be germane to what they might have an interest in. So let's introduce Brian. Brian, would you like to share yourself?
Sure
There he
thing.
is.
Good morning. Good morning. How are you?
We're good. So everybody, we're going to ask you to put your questions in the chat so that Brian can carry on with his presentation. And if you have questions, no question is unacceptable. Please be sure to think outside of the box and ask Brian. Let's see if we can stump Brian at the end. All right. Go ahead, Brian. Take it away.
All right. Well, very good. Appreciate your guys' attention and giving me the time. And if you may have noticed, the lady that just introduced me and my last name are the same because she is my mom. So I appreciate the unbiased introduction there. But nonetheless, I am happy to be a part of today's meeting, and I'm excited to share with you some information. So let me see if I can share my screen here and go through what we got here. So, as Saundra mentioned, we've got Small Business Awareness Month, and like you said, no better time than now to kind of talk about the current economic state of small business and small business lending, and it's quite the rocky road right now, just with the economy being the way it is, and how banks are tightening up and restricting lines of capital for small businesses and so forth. And so that's kind of where my company, my industry comes in. Our industry was founded really out of the need to be able to offer lines of funding and capital for businesses when the banks are unable to or unable to meet the need that you guys have in short-term basis. So we'll just kind of jump right into it. So the name of the presentation is Small Business Lending, the Current Economic Climate, and the Solution for Accessing Capital Now. And really, small business is facing really unprecedented challenges right now. If you saw the headlines in the papers earlier this week, yet another major bank is closed down and declared bankruptcy, and has recently been bought out by JP Morgan, First National Bank, and then of course we had Silicon Valley Bank fall a couple months ago, and several others that are kind of on the chopping block. And it's the state of the economy. There's a trickle down effect when the government prints trillions of dollars and pumps it into the economy, and then also having different indexes not performing as they should be. So that impacts everybody. Small business is also one of the major categories of folks that are impacted the most, especially if needing to run a business and needing capital as soon as possible. So, fortunately, we do have several different solutions that we at Yarrow have access to, and I'll share with you a little bit about how where our company is and different products and companies that we work with. But first off, let me kind of share with you a little bit about my background, who I am, and what kind of gives me the authority, if you will, to kind of share with you this information. Is I've been in the business capital, working capital field, business financing field for over 8 years now. I was with one company for several years and just recently started off with this other company, Yarrow Financial. And I made that move because they had access to several other different types of products and services for small businesses that I felt was a lot more appropriate for different clients that I've been accustomed to working with. So been in the field for a long time, know a lot about the industry, know a lot about business finance in general. Worked with thousands of small business owners over the years, successfully getting working capital to them for anything from adding on staff or buying materials and inventory to financing receivables. You have people that are slow paying clients that are maybe on like a net 30, net 60-day agreement that turns into a net 60, net 90-day agreement if they aren't paying quickly enough. And so that can be detrimental sometimes. But working with lots of business owners that are in similar situations. And I'm knowledgeable on every financial product in the small business space. I feel like as an expert in what I do, it's best to be aware of all the different types of products that are out there, not necessarily just the ones that I have access to, that I work with on a day-to-day, but also just other options that my clients have, in their repertoire. So very knowledgeable on all of that. And I'm also a small business owner myself. I've owned a small business, for several years, and I've had employees, I've had the overhead, and insurance, and payroll, and inventory costs, and operating expenses. So I know the struggles that small business owners go through. So I have a heart for that, and definitely in the space with you guys. So I'm also a husband. I just recently got married back in March to my lovely bride Tracy. And we have a beautiful daughter. Her name is Stevie. She'll be 2. She'll say 2 in May. That's her new thing that she does. And so she'll be 2 later on this month. And I'm also a son. And you see my lovely mom there walking me down the aisle a couple months ago. So she should look familiar because she's the one that introduced me. But so regular person, man. I'm not a big wig. They call us a suit. I'm definitely not a suit. I'm in a flannel. So definitely a real person, and here to help you guys out as much as I can. And of course, got to present this financial disclaimer. This is a legal thing. Of course, I'm not a financial planner. I'm not a financial advisor. Definitely always obviously want to seek your own legal counsel and tax advice, and speak with your accountant and things like that. For different features and benefits of the program, and obviously speak with those that are of higher authority than I am to make each decision. So obviously not responsible for any missteps along the way, but definitely I'm here to guide you and share with you about our programs and what's available to you in that regard. But back to kind of what we're facing right now with small business, with all the bank closures and the economic climate and so forth. Many businesses are not able to access the capital that they used to. Many banks that were involved with the PPP programs and the EIDL programs during the COVID pandemic are out of money, more or less. How a lot of the PPP programs worked is that the bank would finance half of the loan and the government finance the other half. And so with, several hundreds of billions of dollars that are pumped into the small business economy, it was a very needed thing at the time. It was super helpful for a lot of folks. It's created a deficit, more or less, and really banks are struggling to kind of keep up with the demand for financial needs of small business owners. I've had several clients that I've worked with over the past, since the pandemic, that and really actually more condensed recently, that used to have a $500,000 line of credit with Chase, and had a working relationship with their branch manager at their local credit union, that they were able to easily access funds pretty quickly. And now those relationships are not in the same state as they were before. And so if you're in a situation like that, I've worked with several clients that are in a similar category. And so overall, it's difficult to access working capital. And a lot of times, when you're working with the bank, let's say you have a need now, like I need to cover payroll, or I've got a job that we're working on that has an outlay of expenses of over $100,000, or insert your number here. You need it, as soon as possible. Many times, going through the bank is going to be a long and lengthy process, requiring several items of documentation, financials, and having several rounds of underwriting. It can take anywhere between as long as 4 to as long as 8 weeks just to get a result, and many times that result may not even be favorable. So that's kind of where we come in, and we're able to turn approval times around within 24 hours. So that's I'll get a little bit more into that. But this is why we're in the state that we're in. And, of course, like I mentioned to you before, it was a needed thing at the time, and every action has a reciprocal effect. And so this is kind of what we've been seeing is, with the CARES Act, over $350 billion related to small businesses back in March of 2020. And then we had the PPP program, of course, and then the SBA came out with the EIDL program. We also had several other different programs that have been launched since then, to help small business. But with all of that, is just really depleting the coffers of the SBA. Is also putting a lot of strain on private banks and even larger institutional banks that are reliant on customer deposits and in order to back the loans that they've got. We've got a lot of people that are doing runs on the bank, filling up their money because they're concerned about the safety of it, the security of it. And so that all has its effect. And so that's the reason why we're in the state that we're in. INC Magazine came out with an article not long ago, back in December of last year. One of the quotes that I took from it was, innovative solutions are key to unlocking small business success in the current economic climate. And that can be more true. I mean, it's really, a matter of thinking outside of the box, perhaps doing something that may be a little bit unconventional. A lot of people have had, long-standing relationships with their bank, especially if you're in a small town or deal with a local credit union. You may know the banker and the teller and the branch manager all by first name, and know what soccer team the kids are on. But at the end of the day, if those solutions are no longer being effective for you, it may be a time to take a look at different alternatives. So. And furthermore, if we looked at the last year or two of data, this is actually from the Small Business Administration. Bank loans have only consisted of about 25% of the capital that's been dispersed to small business. Private lenders, like the ones that I represent, have been accounted for over 75% of the loans that have been given out over recent years. So it just kind of speaks to how the old guard way of doing things, which is going into your bank and asking for a loan and getting that fairly quickly, is really not been the case as of recent. Definitely the alternative solutions are becoming more and more prevalent. So, what the type of products that the companies that I represent work within is really called the working capital space. So the type of loans that we offer have certain needs that they really cater to, and there's certain needs that they simply don't cater to just because of the framework and structure of the programs. The things that you really can use our capital for is just outlay of cash or normal operating expenses, whether that be for payroll or for upcoming taxes or just really kind of a short-term working capital and cash flow needs. Also, one of the biggest things I work with is bridging accounts receivables. So if you've got clients that are waiting to pay, you've got an agreement with them that they can pay at a certain date, but the expenses are coming before the money is. This is a great way to be able to mobilize and do what you need to do in the short term while you're waiting for those folks to pay. Also, equipment. If you are needing a backhoe or a printer or a copy machine, or you name it, work vehicles, things like that. Also, not a bad use of funds. Materials and marketing. So, anything that's going to drum up more business for you, bringing more clients in the door, add to your bottom line, another great use. And then I also mentioned that, payroll and hiring, kind of different from regular operating costs. But if you wanted to, bring on maybe a digital marketer or someone that can manage your social media, or you name it, anything that you need to bring on a new heading to the company spectrum, then definitely something that can work there. What these things are not for, the types of programs that I work with, are not really best used for is for debt consolidation. The reason why is because if you have several, let's say, credit cards that you're looking to consolidate into a single loan payment, typically the terms that we offer are going to be anywhere between 6 months to sometimes as long as 3 years, sometimes 4 years for some medical practices. I've seen longer terms. But typically with that truncated time frame, what you'll find is that you're going to be your monthly expenditure may be higher than what you're currently paying. And so that may not necessarily address the need, which is normally in debt consolidation, is to minimize your outgoing debt servicing. So probably not the best use for that. Also, real estate purchases, always going to be a better option to get a even 15-year commercial loan, 30-year conventional loan for any real estate purchases that you're trying to do for the business. That's for more of a long-term investment, so usually a better product for that. And also just rainy day funds. You don't want to have access to working capital, have the money deposited into your account just for the day to use it, because of the nature of it being short-term. A lot of times, the payments that you would have on that short-term program will be eating away at that standing capital, waiting for that day to use it. Better to apply when you're in need of the funds within a week or two, as opposed to getting an approval and having the money sit waiting for the day to use it that's not needed for several months out. So just kind of want to set that precedent up front. And looking at different loan options and different working capital programs that you want to that you'd be entertaining and working with, there's a couple of things to kind of keep in mind. Really, you want to understand the logic behind the costs. With the majority of the programs that I work with, with the short-term working capital space, there isn't many times a personal guarantee or collateral on the fund. So oftentimes, if you get a bank loan, let's say that's got like a 5 to 7 year term, their collateral or their leverage against that loan is going to be either your credit score, or you may have to put up a lien on the property, or maybe hand over the ownership to a piece of equipment, or maybe have a lien against your inventory, which kind of offsets the cost a little bit. But there's that liability that's weighing the scale in that way. With unsecured working capital, it many times does not require a personal guarantee and leverage against your personal credit. It's in the name of the business. It's also not going to be have any sort of collateral attached to it. So it's really the risk is really heavily on the lender, and so that kind of ultimately translates sometimes into the cost. Also, we're talking about a truncated time frame. So when you've got shorter term, the cost dollar for dollar can very well be the same as what you would see over a longer term, 5 to 7 year term loan. But if it's collected over a shorter period of time, it may get some sticker shock, just because how I present my offers to clients is you borrow X and you pay back Y. A lot of times that Y number can be a little jarring for folks, but if you realize that it's the same cost of capital, I'm just collecting it over a shorter period of time because there is no collateral against the funding and there is no other thing that's backing the funds. The cost of the money is going to be relatively the same. We're all kind of indoctrinated into an APR, fixed number world, because a lot of the financing that we see advertised on commercials, you see you can get a Honda for 4.9% APR, but what you don't understand, what you don't recognize is that a lot of times that 4.9% APR over a 7 year term in many cases is going to be, if you buy a $30,000 vehicle, doesn't mean you're only going to pay 5% on that $30,000. You pay 5% compounding over a 7 year period. Many times that $30,000 vehicle will cost you, $45,000 by the time it's all said and done, depending on how the structure of the loan is set up. So that's another thing on the cost as well. So moving on from that, the repayment terms. With our programs, there's a lot of flexibility in the repayment term. So like I mentioned to you before, oftentimes the terms will be somewhere between 6 to 18 months. It's usually pretty standard. Oftentimes we're able to get 24-month terms, 36-month terms, and like I said, in rare cases with medical practices, able to get as long as 4-year terms. But with that, you're also able to pay off early without any prepayment penalty, and many times you'll get a significant discount for paying off early as well. So the repayment terms are definitely flexible. And when I get approvals, I'm able to present a spread of different term ranges that will give you different costs and different payments associated with that. And so, when you're working with an expert or you're working with anybody, myself or anybody else in the space included, make sure that you have several different options in front of you. Last but not least, the main thing with our programs is very much a relationship-driven program. So first go around, there's I forget who the artist is, but there's a song that says, the first cut's the deepest. That's usually going to be the case as well in working capitals, because many times with it being unsecured and them really not knowing the business from Adam, the risk is relatively high. The default rate can be relatively high as well, just industry-wide, just because of the unsecured nature of the program. So many times, the cost up front in the very first round may be higher, but the whole idea is to establish a relationship that you can come back to time and time again and be able to bring that cost down, extend the term out more, have the ability to get access to a larger amount of funds with each concurrent round of funding that you get. And so just like when we were 18 years old, we got a rinky-dink credit card for maybe $300 and had $100 annual fee, and you go out for one night of dinner with your spouse or something, and that's taken up right away. Similar thing, after several years of having established personal credit, and you had positive repayments on your monthly payments with your credit cards, Capital One or American Express is going to open up that credit limit to you and also lower your annual APR because you're lower risk. You have payment history on your file. So same thing is going to be in this world as well. Is that the longer your relationship, the more positive your payment history is, the better your cost will be, amount of funding that you have access to, and the length of the term that the lender's going to be willing to offer. So securing a working capital loan is rather simple, and I break it down into really 5 easy steps. And the first step is really, is something that you want to do on your own, which is really just define your short-term need and the amount that you need realistically. So, if you have a project that you're working on, how much money do you actually need capital to actually execute on that job that you need to do? A lot of people, when they fill out an application with me, they have a very large round figure. $100,000 is a pretty common request, but when I really get into the nitty gritty with them, they don't really need 100,000. They need 68, and that's going to do it for them. So it's always best to take just the amount of money that you need. Not much more. Oftentimes, if I'm able to get an approval for, let's say, 100,000, and you only take the 68, well, the remaining, what would that be, 32,000 is actually open and available to you should you run into a need for the additional amount without much of an issue. So define what you need, what you're going to be using it for, and make sure that use is going to have a return on investment for you, or be a betterment to the business in any way. Second step would be submitting an application. We have a very simple application process. It's usually just a one-page application. We look at the last 3 to 4 months of business bank statements. I say 3 to 4 months because in certain states, state regulations require us to take a look at the last 4 months. Other states require just the last 3. So going back to in this month of May, we're looking at February, March, and April statements in order to get an approval for the last 3 months. So you submit that application with the 3 months of statements, and then I'm able to submit the file to several different lenders and get multiple different approval options for you. That brings me to step 3, which is field several different offers. You don't want to take just the first one that comes in. I work with 75 different lenders, and so if I'm getting several different offers, sometimes the best one comes in, 4th or 5th one in. So my job is to give you all of the offers that are on the table and have you be able to deduce which is going to be the best fit for you. Several different options come in with longer terms, but maybe a greater cost, or maybe a shorter term with a lesser cost, but maybe the payment may be higher. You want to figure out what's going to be the best fit for you, whether and what's the most important aspect to focus on. And what I mentioned here is that we're kind of like the Expedia.com of business funding. So when you book a flight, you go to Expedia, you go to Kayak or something like that. You put in your destination, and then you're able to see which airlines are offering which flights at a cost that's affordable to you. So that's the same thing with us. That when we submit a file, we get several different options, and you're able to choose the best one that fits. Step 4 would be negotiate terms. The reason why my clients work with me, or people like myself, and not directly with the lender directly, is because my job is to negotiate not only with you, the client, when I have the offer on behalf of the lender, but also I negotiate with the lender on your behalf to get you better terms and to spell out the story as to what you're using the capital for, and give them the background behind it as opposed to just numbers on a page. So let your representative work on better options for you. And I'm always that's why I do what I do. I love negotiating. So I especially like negotiating with lenders because I'm able to come back with better options for my clients 9 times out of 10. And then receiving the funding. Receiving the funding is very simple. Once we land on an agreement, we sign the agreement. They sometimes a couple steps to do the funding process, which would consist of like a welcome call or a bank verification, perhaps like a proof of ownership percentage. A couple of very simple ancillary things. But then the funds are released, and you get deposited the money into your business account within 24 hours of completing that process. So from cradle to the grave of submitting an application, actually having funds in your account, it could be anywhere from 1 day to I've seen no longer than 3 days. And the difference between the short end of it and the long end of it is really on you. Is how fast you want to move on it, and what in making your decision as to what you want to do. The most important things when looking at, working capital loans from private lenders, I have them in, kind of this order because I feel like this is really the priority. First and foremost and most paramount is going to be, the quick access to funds. It's Thursday today. If you've got payroll to run tomorrow, checks that are going to clear by Monday, put in an application and get in the approval by this afternoon and have the money in your account by tomorrow. That's a big, big value and big benefit. And that's something that, our companies are able to do, something that the bank is going to take much, much longer to do. So that's really kind of what has to stand apart from those types of programs in the main, as a main kind of aspect. The second major thing is, there's no collateral required. So I don't need to go out to your place of business and get a appraisal on your property or get an invoice from your inventory that you're about to get, or collateralize any sort of equipment. So that collateralization process and it is just not existent in my space. So again, kind of speaks to the quick access to the funds. The flexible repayment terms, very much wanting to fit the approval into your need and your expected outcome, and also your outlay of the capital. So, if you need, $40,000 now and you've got another site in mind in 60 days from now, well, let's get you 40 now, and then let's look at getting you some more later. No need to take a huge amount right off the bat just to have the unused capital just sitting in your account waiting for the day to use it. There's flexible terms and different strategies that I work with my clients in order for them to be able to use the money when they need best and have it be most cost advantageous. And then competitive interest rates. And the reason why I say that's part of this is because the rates that we offer and just the breadth of lenders that we work with give us a good sample size of what's available in the market in terms of what your company is going to qualify in terms of its risk factor and what your costs could be associated with that. And I have several different lenders that have great rates in terms of the total repayment costs, and again, able to work on those and negotiate those with them on the upfront, and also any recurrent relationship from that forward is always going to get better. The lenders are always sweetening the deal each time you come back because they love to keep your business and have you be have them be a reliable source for your business ongoing. So like I mentioned to you before, I'm versed on several different types of financial products in the small business space, and I feel that there are certain pros and certain cons to each of them, and how they contrast to working capital in the short-term world. So we'll kind of jump into that. First and foremost, bank loans, we talked about that. Bank lines of credit. The pros on that end is that, of course, they offer longer terms. Sometimes 3 to as long as sometimes 10-year terms. It's a traditional method of financing, something that people are accustomed to doing. It's something that they've either done before or kind of a trusted method. And many times you have a relationship with your bank, like I mentioned, and it helps you build your personal credit because you have that personal guarantee. If you're taking a $250,000 loan out of the bank and you're positive repay that back, when it's said and done, your personal credit will be positively impacted from that. Now, the cons of it is, it's a long-term financial obligation for a short-term need. I always impart to my client the illogical thought process of taking out, let's say, even a 5-year loan on something that you're going to see the fruits of its labor in a relatively short amount of time. So let's take even inventory. If you buy $100,000 worth of inventory and you sell through that within 3 months or even a year, you've seen the return on that investment within as long as a year's period of time, and yet you're paying on that for an additional 4 years after that profit has been realized. So now that becomes a strain on the business as further as the years go out, and also reduces your ability to access more funding until that's paid off in full. And so you want to make sure that the need that you're trying to address matches the product of financing that you're getting. So oftentimes these loans are going to be personally guaranteed. I've mentioned that several times. Weighs on your personal credit, affects your ability to mobilize in your personal life, whether that be for student loans or for purchasing a home or getting a vehicle or getting credit cards, things like that. Many times when I talk to small business owners, and we do a soft credit check on their credit, a lot of times people's personal credit is mangled and tarnished because of their financing their business through their personal social security number and their personal credit. you want to keep the right eggs in the right basket, right? So if you're financing something for your business, the business should be the one that's, credit history is being built, not your personal side of your credit world. So definitely I feel there's a con in that regard. It's a lengthy process to get these bank loans are between 1 to 4 weeks, and that's actually exasperated now that the current economy is the way it is. Many times it takes as long as 6 to 8 weeks to get an approval or a decline. So again, fast access to capital is where our programs kind of stand apart. Strict requirements for qualification. So many times, if you haven't applied for a bank loan in the past, the requirements that banks have many times is going to be really stringent. So you're going to need to show 3 years of profitable tax statements at least. You need to be able to show your P&L statements, balance sheets, accounts receivable, accounts payable reports. They work with certain industries and not with other industries. You have to keep an average bank balance. There's a lot of requirements that are in place for bank loans in order for you to get solid approvals in that regard. And also, all banks are going to require you to have a minimum of 3 years in business in order to even, fill out an application. With our programs, the minimum is just to be in business for at least 6 months, and also having at least $10,000 a month deposited into a business checking account, which is fairly easy for any operating a functional business. Second financial product that a lot of people go towards is going to be credit cards. And I mentioned, how that, has affected people's personal credit on the negative end, but, it also does build your personal credit. If you're, positively paying on your credit cards and making sure that you're meeting more than the minimum payment, keeping a low debt to income ratio that can help build your personal credit. With the credit card, just something you carry in your pocket and you can use the funds as needed. And so that's a positive. And, again, it's easily accepted by all, merchants and vendors in the nation. So, it's an easy form of transaction. Of course, the cons are the compounding, ever accruing interest, the personal guarantee that we mentioned. It can negatively affect your personal credit just as much as the positive influence it. And it's also a very slippery slope for ongoing business expenses. If you're putting, your payroll on a credit card, or you're buying equipment on a credit card, and that's on your personal your credit profile. That's a slippery slope. Heaven forbid something were to happen with the business and those cards are personally in your name, or even if you've got the business name embossed on a credit card, if you read the terms and the conditions of those credit cards, they're always going to be personally guaranteed. There's very seldom, business credit cards that actually are 100% the name of the business. Now they are out there, and they are, available. But the majority of the clients that I've worked with, have a credit card that has the name embossed on there, the business name on there, but is actually a personal guarantee card that does show up on their personal credit. So if you fold the business, unfortunately, you're still left holding the bag personally for the debt that was accumulated on those credit cards. So something to be aware of. SBA loans. Now, this has been a big conversation over the last couple of years, especially in light of the pandemic, and a lot of people have flocked to the SBA for different financial needs. And they do have some serious positives, and if you're able to get qualified for them, I definitely suggest at least exploring that road, because it's relatively low cost of capital. Many times we have 15, even 30-year terms with the SBA. And we all pay our taxes, and this helps fund that, so you can get some of your money out of what we've been contributing to all these years. And they do have, like I said, long terms. Cost of capital is relatively low, and they approve really decent sized loans for those that are well qualified. If you've got a multi-million-dollar business that you're bringing in annually, the access to those funds is can be rather large. And so again, I'm not against SBA loans. I'm partial to what I do, of course, but I definitely recommend looking into that if you're able to. But it does come with some negative effects as well. So the cons of SBA loan is that it's commonly considered the most difficult to get approved for. Government's never easy, right? And they're very quick to take our money, but very slow to give it to us unless there's some sort of a relief fund and that kind of thing. But if any of you went through that PPP or EIDL process, that it took a lot of documentation to get to that. It took a lot of vetting of those documents that you sent over, and took a long time. So it can be a very difficult and frustrating process. Aside from that, I mentioned, the process can take several weeks or even months to know the outcome of your application. So if you're looking to, get funding rather quickly, this is not the option. The eligibility requirements set by the SBA are very, very high. So if you've got anything below, I would say even a 720 or 680 FICO score, that is very well the reason why we wouldn't get approved. If you've got your balance sheet is offset, and your accounts receivable doesn't match your balance sheet, that's going to be the reason why we don't approve you. So their requirements are really, really strict. And again, I mentioned any blemishes on your personal or business financial history can hurt your qualifications. So, you've got to have a squeaky clean business in order to get approved from the SBA with a well-detailed business plan. And there's a lot that goes into that. But again, I don't advise against it. It just, these are the things that are required in order to get qualified for them. I love talking about this because, this seems to be a alternative that a lot of business owners mentioned to me when I presented approval, and then this becomes their I don't want to say excuse because it's really not an excuse, but this becomes their now alternative option as opposed to accepting the funds that we get them approved for, which is a home equity line of credit. I can't stress enough, and if you talk to any financial advisor, which that I'm not, but from every article that I've ever read, every major financial guru that I've ever spoken to, taking out a home equity line of credit for your business is probably one of the most risky things you can do for your company. Let me explain to you why. So you've got a home. Let's say you've got a home that's valued at $1 million, just for easy conversation. You've got maybe $200,000 of equity in that home. And you take $200,000 out of your home and you put it into your business, and that's a relatively low interest rate you're going to pay. Now then, it's going to be higher than what you paid on your initial mortgage because it's taxed over your second. And so you're looking at somewhere between 7 to 10% APR on your home equity line of credit. But it is funds available rather quickly. You can get the money distributed to you probably within a week of your applying and getting approved. But now you've got a second mortgage on the home, and you are using that for your business. Now, one of the reasons why financing in the small business world is a difficult thing is because of the risky nature of it, right? It's a lot easier to get someone that's, has a W-2 9 to 5 getting paid, once every on the 1st and the 15th with a good credit score than it is to get a business owner approved, because the business weighs on you. The employee is going to get paid for showing up to work. But if you show up to work and your business isn't working, then unfortunately you don't get paid. So the onus is really on the business. And so now you're putting the equity that you built in your home on the business. And if heaven forbid something were to happen with A, the business, B, the economy, your industry, any of the risks that are inherent with being a business owner, now you're weighing that on your livelihood of your home. So now instead of, many times as a small business owner, the income from your business is paying for your mortgage that puts a roof over you and your family's head. Now that business goes under, that not only is your mortgage you're going to be having a hard time to come by, but also the HELOC that you took out that has a required payment is also going to be hard to come by. So a lot of times people not only lose their home, they lose their business in a bankruptcy of the business, they also lose their home because they have that tied in and commingled with their business. So it's a very large risk, and it's definitely not the best solution. It seems to be an easy access solution for a lot of folks, but many times it's not. And when you look at the cost of a home equity line, if you qualify for $100,000 HELOC at even 6.25%, which this slide I had for about a year ago, that home equity lines are even just as regular mortgages in the 7s now in many areas of the country. So home equity lines probably going to be more like 8%, but we'll just use this example of 6.25. And if you pay that over 20 years, on the surface it might look like it's a cost-effective option, but actually you're going to be paying over $127,000 in accrued costs for that line of credit over a 20-year period. So again, you got to ask yourself, the $100,000 that you took to purchase inventory or use that short-term need, is it worth paying over a 20-year period over $127,000 in costs? That's over 120% overall on the cost of capital on the initial capital that you borrowed. So these are all things to consider. Now, again, going back to what our programs do and working capital programs, the short-term obligation for short-term needs. So kind of keeping the right eggs in the right basket, like we talked about before. Again, terms range between 4 and 48 months. You're able to keep it in the name of the company, often without a personal guarantee. You're building that relationship with the lender, like I mentioned several times, and you're able to build your business credit. It's a flat fixed cost. So you're going to know exactly how much you're borrowing and exactly how much you're paying back over the agreed upon term. So you can work that into your margins. You can work that into what you charge your clients. You can work that into any late payments or late fees that you would charge clients that are slow paying, which I always advise business owners to do. Like if you've got slow paying clients, they're supposed to pay on at 30 and it's now day 60, day 90, there should be some penalty for that. They shouldn't be able to not pay you for your work that you've rendered. You've got a business to run, and there should be some incentive for them to pay on the agreed upon terms. So with this flat fixed cost, you're going to know exactly how much the cost of capital is going to be costing you. If you're needing to bridge those receivables, you can pass that cost along to your clients that are now late in paying you. So you can work that into your math when you do that. I mentioned several examples as to how working capital can be used, but these are just some case studies. These are actual clients of mine that I've worked with in the very recent past that did exactly this. So I had a merchant that needed $100,000 for inventory. His typical profit margin was at 25%, and his turn time for selling out the purchase inventory was roughly around 3 months. So the approved term was for a year, and he was able to recycle that money 4 different times during that year cycle, basically taking that $100,000, turning into $125,000 within 3 months, and then taking that $100,000 again and turning that into another $125,000, et cetera, for a total of a 4-time investment over a 12-month period. Therefore, he was able to profit $100,000 off of the same one-time $100,000 funding event that he took in the very beginning of the year. So over a year period, he was able to turn that $100,000 into an additional $100,000 in profit, and the cost of the funding was only at 23%. So if I gave you $100,000 and you can turn that into $200,000, I'll ask for you for $23,000 of your profit to be able to do that, and you're still netting $77,000 in profit. I think that's something that you would probably revisit time and time again. So another case study here is I had a merchant that had outstanding receivables of over $500,000, but needed about $100,000 in upfront cost and labor in order to receive that money with the jobs that were going to be completed. So without having that money, he was going to face losing that client to another contractor. He had another contractor that had bid on the job, was able to do it right away, and so he needed the money in order to be able to keep his foot in the door and to secure the work. So the scope of work was going to take about 3 months to complete, and all of the contracts he was going to get were going to be about a net 30. So he was approved for $100,000 over a 9-month term. The merchant was able to pay off the capital funding in 4 months, and he was able to receive an early payment discount for doing so. So the cost of him getting that money yielded him $400,000 extra in revenue, and the cost of capital was extremely low because he was able to pay it off within 4 months after he completed the jobs. So that's another example as to how these types of funding work really well. So this is a company that I work for. Its name is Yarrow Financial. They're one of the biggest small business funding brokers in the nation. So I would say we are a broker. We are not a direct lender, but we work with 75 of the largest private lenders in this space. So you may have heard of On Deck Capital. You may have heard of Can Capital. We have several different options that offer lines of credit, things of that nature. So there's different types of programs that we offer. Our company is comprised of all industry seasoned veterans. So every single one of the people that work within my company, from the underwriters to the owners to the individual account executives like myself, we've all been in the industry for several years. I think a minimum of 5 years each. And so we know what we're doing. We've been in the world in the space for a long time. And, direct first name basis relationships with many of these lenders and partners. So we're able to speak with them directly as opposed to just being another name on a board somewhere. And the type of lenders that we work with offer several different types of options. So we've got your working capital loans, which is just a one-time cash infusion, short-term repayment, We also have lines of credit that are in the name of the business that are ever revolving. So I actually just this morning, I set up a client out here in San Diego for a $200,000 line of credit, and he took a $20,000 draw to get it started. So he has another $180,000 available to him anytime he needs it, and that's in existence from now until he decides to either sell or close the business. And so that's another option that we have, which is lines of credit, which are fantastic. The rates are very, very competitive. You're paying for time of use, just like you pay for on your credit card, but it's always going to be in the name of the company. So we do have access to those types of programs. We also have midterm loans as well. So like I said, sometimes the terms can go out to as long as 48 months. And so I would consider anything from like a 2-year to 4-year term to be like a midterm loan. So if you have something that's going to be like, sort of for expansion of the business, so if you're looking to, open up another location or do a build out of your restaurant, expand your space to, be able to cater to more clients, that may be more suitable for, a longer term, kind of 2 to 4 year option. And we do have access to those as well. So nice thing about our program, what you can expect from us is that we don't do a hard credit check. There is a soft pull just to make sure that there isn't any open bankruptcies in your name or any judgments against you or the company that would have the funding that we issue fall into a black hole or be subject to collection or seizure. So just a soft pull done on that. The approvals range anywhere between 5 to 15% of your annual gross revenue. So you can do the math on what you do annually, and it's relatively where you would fall in terms of qualifying. Like I mentioned several times, terms 4 to 48 months, and the rare cases of being a medical facility. Usually, the kind of sweet spot is that 4 to 24 month range. Flat fixed costs, you know exactly how much it's going to be. It's presented in like an APR type of a framework. We tell you, borrow an X and pay back Y. The early payoff discounts mentioned several times, and the approvals in 24 hours. So again, very simple process. I think this financial feature is definitely something that all small businesses should at least explore and entertain, and see if it's a good fit for you. So there's my name and contact information. I have an office line and my cell phone number there. You're welcome to call me, text me, email me anytime you like. I'm happy to set up a free consultation for you. My process is very simple. I just basically ask several questions to find out what you're needing and the type of approval that you're looking for and what you're planning on using the funds for, and basically make sure I can pinpoint the type of lender, the type of product, the type of term that you're going to need in order for it to make the most sense for you in the long run. And I'm one to walk away from the deal if it doesn't work for you. I'm not a type of person that likes to cram a square peg into a round hole. If it doesn't work, it doesn't work. But if you're able to find something that does work for you, I'm happy to start a relationship with you and be a resource for you on an ongoing basis. So that's the end of my presentation. Appreciate you guys' time and attention. Happy to open it up to any questions, comments, concerns, and if you need anything, I'm here for an open chat.
Well, thank you, Brian. That was really informative, especially with the small business climate. PayrollCentric has been working diligently for the ERC credit loans, and we understand that the IRS is 11 months behind on getting those refunds to our clients. So that might be something that small businesses are waiting for in order to give them a jump start back into the world post-pandemic, and they're not coming. So you might be that short-term solution while they wait for the ERC to come back. So it's really a timely topic for us. So I thank you for doing that. And for our clients, we do these types of webinars with guest speakers on topics that might be of interest that could help your small business thrive. We've had, of course, labor law attorneys and people who talk about cybersecurity. And of course, this presentation on small business capital funding and loans. And I really think that it was timely. And I appreciate your time, Brian. It took a lot to put the presentation together and your time spending with us today on the phone. I don't see any questions in the chat, which means you did a great job. So I really appreciate that. If any of you, after we end this conversation, have questions, please feel free to email me. I'll get them off to Brian. Or, of course, you can see his contact information right there. Take a screenshot so that you can keep it for future reference. I also am going to request that you forward this email and presentation to the owner of your company if you don't happen to be that on the call today. You never know. Your owner's not going to come to you and say, hey, we need some capital. They're not going to tell you that, but it might be the perfect gift that you've given them that they don't know that they need. All right. So with that, I'm going to say thank you, Brian. If there's any other comment you have, I'm open to that, and then we'll stop recording.
No, that's it. Thank you so much for your guys' time and appreciate your attention. Again, you have my contact information there. If you need anything, feel free to reach out.
Okay. So please join us next week. We're going to be talking about out-of-state hires and employee-employer tax forms and state-specific regulations. Charles is going to be flying solo on that, and he will be handling that dash information for you. And then the following week, we're going to be talking about adding new employees and entering direct deposit and terminating employees. We have covered that before, but it seems that we have questions that come up all the time on that very topic. So we want to make sure that you're well educated. Thank you for your time today. Thank you for joining us. And thank you for being part of PayrollCentric's family. Bye-bye for now.